We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Don Durrett, author, investor, and founder of goldstockdata.com. How are you today, Don?
I'm doing great, Tom. Thanks for having me back.
Of course, always great to have you. And of course, we're speaking on today, May the 3rd, right after the Fed meeting, and Powell announced that they are raising the headline interest rate by another 25 basis points. So I wanted to get your take on this and what happened here. Was there anything that surprised you about this meeting, or is he just sticking to the course that he has already laid out
here? It's shocking to me that they don't realize how much damage they're doing. It's quite shocking. I think the poll was like 57% were against this raise because they thought that they were making a mistake. And, it should be 80% were against it. And I was, confident that they were going to do it because the last raise, there was no dissensions. There was zero dissensions back in March. And I thought, that's kind of odd. You would think there would at least be one person who, basically said, wait a minute here. We're basically killing the banking industry. The economy is going into recession already. Inflation's dropping like a rock right now. Why are we raising rates? What's the point of this? Because I think that the Fed is creating more damage than they realize. I was listening to Chris Whalen yesterday, and he was talking about how he doesn't think the Fed really understands, how their policies impact the banking industry. It's like, they're kind of in a, they're looking at the wrong data. That was kind of his point. And I agree. I think that they're looking at the wrong data and they're focused on the wrong thing here. And you watch how fast they flip. That's the reason why right now the expectation is they will lower rates twice this year. They're currently at the upper band's 5.25, and they're going to take it all the way down to 4.5. So by the end of the year, I think it'll be lower than that. And the reason why is because once the economy turns negative, GDP turns negative, and first quarter was 1.1%. And so in the second quarter, it might not be negative, but I would expect it to be less than 1%. So, we're basically quasi-recession as we speak. And so the damage that's been done to the economy, and this really goes back to the year 2000. This damage isn't, COVID has damaged, small business to a high degree. But what the Fed has done from 2000 to now is very dangerous, because what they've done is they've basically broken the free market. So the free market is supposed to price in assets and supposed to price in valuations of companies so that investors can push their capital around and grow the economy through, the market machinations of, where money should go, right? Mm-hmm. And by taking interest rates down to zero, they basically, have broken the free market. I mean, they basically have copied Japan, and I thought they would have, cringed at what the Japanese did in the 1990s by basically, printing, exploding their balance sheets. I mean, the Japanese central banks basically started buying up all of, the bonds, the Japanese government bonds, and they were buying up all of the stocks. Most people don't even know this. They were buying stocks as well. And they were basically just exploding their debt. And by doing that, this is the key here. By doing that, they basically damage the free market. Mm-hmm. Because when you have interest rates at zero, how do you price assets or price businesses? It's difficult. It's like, what has value? Zero interest rates, right? You misprice things. You misprice the market. I mean, look at, used cars, used cars during COVID, they kept going up, because there's zero rates, right? They were mispriced. Housing, again, mispriced. They basically went up basically to the moon. And now how are they going to come, how much will they come back down? Will they become affordable? And so you get this mispricing, which is kind of what the Fed started doing after 9/11. When that recession hit, they basically started adopting, MMT model that the Japanese invented, which is basically taking rates to zero and printing money. Is take them all the way down and print money. If you do that combination, the Japanese said, well, if we do that combination, it seems to prevent a recession. Mm-hmm. And Janet Yellen actually said, when she was the Fed chair, she said, we will not have another recession in my lifetime. She's like totally buying into this MMT baloney, right? We won't have another recession because we're going to have zero rates and print money whenever the economy starts to slow. We'll be fine, right? But once they adopted that, you can see what's happened. Their balance sheet now is $8 trillion. Their balance sheet in the year 2000 was $1 trillion. And MMT changed that whole dynamic. And now we're going to watch their balance sheet explode to 20, 30 trillion. If it can get that far before we get this massive, I don't know exactly the term. Some people call it a reset, and it's kind of some type of a reset. I think is coming, not in this year, not next year, but maybe 3-4 years from now. I think we're going to get this reset where MMT basically broke the system to such an extent that we can no longer afford to just keep printing. So if you can't do that, you have to do some type of a reset. Otherwise, the whole thing comes falling down. Mm-hmm. So this raise, again, the damage. So the only way that the economy could not go into recession from 2009 to 2016, 18 was by keeping rates low and injecting money. Mm-hmm. And every time the stock market went down 10%, then you could see the money supply grow. It was like, and money supply, if you overlay the money supply with the stock market, it was like constant growth. Well, now money supply is actually negative year over year. Mm-hmm. That is basically just screaming, here comes a recession when you basically suck it out. What's amazing is the stock market has not rolled over yet. It's about 4,100 today, which I think is, over 10% overvalued. And when the selling comes, which I think it will very soon, that is going to be a big shock to the system. And that's when the recession comes.
So, Don, you mentioned the Japanese playbook of keeping rates low and, printing a bunch. And, Powell announced in this raise that interest rates are going to remain high in order to basically tighten monetary conditions. And then on the other side of this, the ERP program is, extending these loans to the banking system, kind of indirectly, we've talked about the intricacies of that, indirectly introducing more liquidity into the system. So is this how they keep trying to fight inflation on one hand while, trying to engineer a soft landing on the other side of it?
I think that the Fed's objective, which has basically been in place since like September of last year, their objective is to kill inflation back to 2% in order to get their tools back, in order to get MMT back in play. They want their tools, and they want that sense of strength where they can have rates at zero and print money whenever there's a hiccup. Mm-hmm. They want to get rates basically back to zero, back to 1, the Fed funds really, really low again, because our debt is so high. I mean, our interest rates right now is over $500 billion a year. So they got to get rates back down in order to get that. They need to get that under control. Mm-hmm. They need annual interest rates to be, let's say, 300 to 400 billion. Maybe 300 would probably be. They'd be happy with 300. You hear Yellen, she's always talking about interest rates versus GDP. It's not a problem. It's not a problem, right? So they want that tool back. So since about September, after August of last year when Powell, he gave that speech and kind of changed everything, and then they started raising aggressively in September. That changed the whole tone. That's when Powell basically became Volcker. That I think that is their right now. That's their whole focus, is basically fighting inflation, and they're ignoring the banks, and they're ignoring GDP. They're ignoring the economy currently, today, as we speak. They have one agenda. One agenda is fight inflation. QT hasn't stopped. We have this, like I said, year over year negative money supply growth. So, but I think they're going to fail at their agenda, basically getting inflation back to 2, where they can fail getting what they want to do. Their objective is to get inflation 2, where they can basically take interest rates to 0. And I don't think they're going to get there. And so because the economy is damaged to such an extent that when they go to, right now, they're going to go to pause, I think. I think they're going to pause here, not going to raise in June. They go to pause. The economy, we're already, all of these rate hikes are going to start to take effect. And as they start to take effect, the economy is going to start to roll over. We had the highest 60-day warn notices, higher than 2008 for March. Those 60-day warn notice is what's required if a corporation is going to do mass layoffs. I don't know how many more, 50 or 100 people or whatever. If you're going to do a mass layoff, you have to submit a warn notice. And there was more warn notices in March than at a percentage basis than, if you look at the graph, it was higher than 2008. So the layoffs are coming. And once the layoffs kick into gear, then the Fed will pivot. They basically will go, now our number one problem is the economy. It's not inflation. And they can't do, the way the Fed thinks, they can't do 2 things at once. They can have one priority, one focus. And so they're basically going to pretend that, inflation's, going back to 2%, but they're going to make sure that they have enough liquidity in the market that the whole system doesn't crash. So their focus will be from, liquidity, the financial system, employment. They talk about killing employment, but the irony is that once they pivot to basically regenerating, I don't know if regenerating is the right word, restarting the economy. Once they pivot to restarting the economy, that's when the problems really start. Because I really believe this is it. The Jeremy Irons, his quote in the movie The Margin Call, when he takes his finger and he hits it on the table and says, "This is it." And I really believe this is it. What I mean by that is Peter Lynch. He recently was on cable news in a short 3-minute interview, and he talked about how we've had 12 recessions since World War II, and we had 12 corrections, 12 recoveries, excuse me. And this is going to be no different. We're basically going to, don't worry, we'll have a recession here and we'll just come right back out of it. It's just the same old story. Well, it's not. This isn't the same old story. This has been building for 20 plus years. And the US has basically been able to basically make all the rules on international trade and been able to benefit from that. And now it's all basically starting to crumble. And so we're losing these strengths that we've had. For instance, our productivity levels. One of the reasons why our productivity levels have been strong is because of low prices, low inputs. If you're going to have high productivity, you better have low inputs, right? So we had all these low inputs from China. Well, commodities are flipping here. We're going to start to go higher commodity prices, higher inputs. We're not going to have this, productivity is going to get hit. Costs are going to get hit. Our standard of living is going to get hit. It's all basically, it's the perfect storm. I call it the end of an era, a paradigm change. And it's all happening right before our eyes here. And the Fed and Powell are basically the trigger. They're basically pushing us into this era change faster than would have happened. The combination of the Ukraine war, which basically, caused all kinds of geopolitical and international trade ramifications, and the higher rates, which are damaging the economy, and COVID, and not to mention our political system, which is totally broken. So if you don't have a political system that's working, how are you going to have an economic system that's working? So the craziness that we had from 2020 to 2022 it's not over yet. That craziness is actually going to get worse here, 2023, 2024. Some people say that, this recession might not even start until 2024. Some people say it's going to be a soft landing in 2023. I basically say, hold on to your hats, because this is going to be a much nastier recession than 2008 or 2001. It's going to be more like a 1980 type recession, where it's going to take a while for this economy to recover, for this economy to get back on its feet. And I don't think it's going to. I really think this is a paradigm change where we literally do not get to where we were at. It's going to be a lot like Japan. So Japan basically peaked in 1989, and they've never gotten back. This is going to be our lost decade. So their lost decade was 1990 to 2000. This is going to be our lost decade, and it's getting ready to start very, very quick.
Yeah, Don, to that point, recently GDP came in almost a whole percentage point under estimates, and other numbers like, something as simple as UPS delivery earnings down significantly. That seems like the markets are, priced for perfection here versus the reality that everything seems to be showing us that things are slowing down. So, when do you think that the markets acknowledge that we are at least heading for, if not already in, this recession?
Wall Street is basically cherry picking the data. And one of the reasons why they're cherry picking the data is because you can't argue with your wallet. Whoever you work for, you better be on the same page as them, or you're going to be a pariah. I record and I watch the halftime show to get the pulse of Wall Street. And their analysts are basically all bulls. There's a couple of them that have, a little bit of bearishness. Steve Weiss is probably the most bearish, but he's like a baby bear. He's not a serious bear. He's still buying stocks, thinking that he's still going to make some money this year. And he has to be really careful what he says, because they basically attack him if he's too bearish. But my point is that Wall Street's basically lost their mind. They basically are cherry picking the data, and they're ignoring all of the data. If you look at all of the data combined, the chances of a soft landing is pretty low. I mean, Stanley Druckenmiller has basically been, he had a couple interviews recently, and he's basically telling everybody, I've been doing this for a long time, and I can tell you this is not good. This is really, really, really ugly, what I'm seeing here. And he's not the only one. Many are, the people that I follow, there's not a single one that sees a way to avoid this recession. And what people are not getting is that this recession is going to be deep and long. It's not going to be, the Fed's losing control here. They're losing their tools. And without those tools, the ability to basically inject money, and the omen is the banking system, right? We've lost 5 banks, including one in Europe, 4 in the US, one in Europe. And we're going to lose a couple more, most likely. And the banking system is basically, that's the canary in the coal mine that's showing you that this is going to be a long one, that this isn't going to be a quick one and done, because the Fed doesn't have a lot of bullets, basically to re-inject this economy, re-inject the banking system. They fixed, it's pretty interesting is prior to, First Republic going down, there was a lot of commentators saying that this is done, this is fixed. Totally wrong, right? And so that was the kind of that herd mentality. We have to all stay positive here. But the banking system is damaged as I speak. Chris Whalen basically says they have to, raise their rates, when they don't want to do it, because, for instance, Apple just created their own savings account. You can basically throw money into Apple and get 4.15%. And a regular savings account for your neighborhood bank is probably still 1%. So they're like this 3% gap here. And so people are going to be moving their money. And so that's a big problem. How do all those banks kind of, raise their rates? And if they do raise the rates, then, already we have credit contraction. Credit contraction meaning the ability to make loans. There was one developer who had good credit, trying to build a 30-story building, and he went to 100 banks and none of them would give him a loan. not because he doesn't have good credit, but because they currently were not giving loans to anybody building 30-story buildings, which is pretty insane, right? This is America. I mean, come on, you can't, get a loan if you have good credit. So it shows you credit is really starting to shrink, if you will, going into a recession. So you got credit contraction before the recession. What do you think is going to happen when the recession begins? Then you got the Fed basically saying, look, we're not going to lower rates this year, but we know they will once the recession starts. And you have Wall Street basically saying, don't worry, earnings, you said price perfection. And you said earnings are going to, basically come in at 220. Well, my target is like 180, 190. They're way off what we're going to get to, because once the recession starts, they're expecting the earnings to be good in the third and fourth quarter. Well, if we're going into a recession, earnings are going to be even worse in the third and fourth quarter. So, price perfection, absolutely. And they're way off. And that's why I say basically they lost their minds. And so once this all starts, once the selling starts, and now we can get to gold, right? I believe the selling is going to be fierce. That's the word I'm using, fierce. So we're at 4,100. So, you take 10% of that is 400 points. That takes you to 3,600. You're still not at a new low. The new low is like 3,500. But once you get below 3,700, and I think 3,700 is a really important number, because people are saying, okay, what's gold going to do here? Is gold going to hold at 1920? And I say it could, because the price action has been very good the last 4 weeks. I mean, we got silver, it traded above 26 this week. It's trading about 25.50 right now in the futures. And so silver is really kind of showing that, it really wants to run. It gets above 26. It's really starting to get there. Gold's been, trading above 2,000 most of the week. It's over 2,000 right now as we speak, 2024. So, the price action is showing that gold wants to potentially break out here. But if the selling is fierce, like I said, if the S&P is going to go down, if it goes down to 10%, so 3,700 on the S&P, we won't know what gold's going to do until gold gets to 3,700. When it gets to 3,700, then we can look at the gold price and we can get a good feel for what gold's going to do. Because if they can't pull it down in the next 400 points from 4,100 to 3,700, they can't pull gold down, then they're not pulling it down, period. So, but I think when we get to 3,700, I think gold's going to be down at 1,830, 1,850. That's my feel. But I don't know. I think the odds favor gold going down here one more time, just because that's usually what happens, is that you get this massive sell-off, this fierce, quick sell-off. Gold tends to go with it. Everything tends to get sold. But this is a different thing. This is, like I said, this is a paradigm change. And everybody's starting to realize that the American economy is not what it was 20 years ago. And so everything is starting to break down. So under that scenario, I think that it's possible that gold could hold 1,870, 1,900, even 1,920. It could hold these areas because of this fear factor. People run to gold because they realize that, this is a paradigm shift. This is a big thing. This is massive. But I don't know if Wall Street is ready to really think that way. I think Wall Street wants to keep thinking that the Fed's going to save them. And if Wall Street has that mentality that the Fed's going to save them, then gold will go down to 1,830, 1,800. I do think 1,800 will hold. This is an important one. So you got 3,700 to keep your eye on. The other one you want to keep your eye on is 1,800 gold. That's a really important support level. If 1,800 holds, I think we go to 2,300 this year. And the higher that low is, so if we bottom out at 1,830, 1,850, 1,870, the higher the low is, the faster we bounce. If 1,870 holds, we could be 2,100 in June. Gold wants to run here. It wants to run, but it has the headwinds of the markets. Has the headwinds that has to get cleared. That headwind has to get cleared. I've been saying this for over a year now. Basically, gold is stuck until the S&P gets out of the way. That's what we're waiting for. When it gets out of the way, that's when Wall Street has to acknowledge that they have to go to gold. they have to go to safety.
Mhm.
Right now, they're pretending they don't have to go to safety. Like that halftime show that I watched, you never ever hear them talk about gold or going to safety. I think one guy said he bought Newmont. I mean, but it's one out of, they have like 6 rotating guests. They never talk about gold when, like my Hummingbird article that I tried to submit, I mean, they're trading at $105 million. I'm just telling you how insane it is that people are ignoring gold. Hummingbird, $105 million. They're going to be producing at a 200,000 ounce per year clip. Say by the end of summer, 200,000 ounce producer at 105 million market cap. That's insane. Just to give you an idea, back in 2011, a good 200,000 ounce producer was worth at least $1 billion, maybe more. So that's kind of a 10 bagger. And if gold goes crazy, gold goes to 3,000, which I think it will, you can imagine what the value is going to be. And that's just one stock, right? I have 80 10 baggers on my list right now, 80. Now, they're not all good risk rewards, mind you, but about 20 of them are. And of those 80 10 baggers, I analyze all of them. They're only reason on that list because I put them on that list. Mm-hmm. And they're rated either, I use a rating for upside and downside. The downside is the risk reward. If I have a 3 downside, that's a really good risk reward. 3 5 is as high as I go. But so I got a stock rated 4.3. That's a pretty darn good rating. The other ones are rated 4 2.5. 2.5 is like marginal risk. It means, yeah, there's some risk there. But a lot of these companies that have marginal risk, they're going to get very, very healthy when the price of gold gets to $2,300 or higher. Very healthy. So you got 80 stocks out there to look at, and Wall Street's like, I don't care. I don't want anything to do with these things.
Yeah, that rotation of capital, I think, is something that is going to blow a lot of people away when that comes. But you're mentioning these big round numbers, and we saw silver seemingly get to this psychological number like the $26 level, like we saw this week, and it got rejected pretty heavily. So, what do you see as an explanation of this, Don?
So, some people were trying to say that this had nothing to do with manipulation, that basically there was a couple of factors that basically, immediately pushed it back down, that there was basically, people that, were selling, it was an opportune time to sell. So first of all, in order for, it went up about $1 in a very short period of time. It basically it was a big, quick move from like 25 25 to 26.25, something like that, fairly quickly. So in order for silver to move that high, it takes a lot of money. Mm-hmm. Somebody went in and bought a whole bunch of silver. Now, silver has been trending upward for several months, from 22 all the way to 25 and now 26. So it's basically in an upward trend. Simultaneous to that, silver is about 50% undervalued versus what it really should be valued at. I mean, if you look at historical numbers, like the GSR is at 80, the GSR really, should be, I think, around 60, maybe a little bit lower than that, but it should be around 60, I think. So silver is undervalued. It's one of the most undervalued stocks. So it makes you think. Now, let's just look at some of the facts here. Gold and silver compete against stocks and bonds. You don't want gold and silver to basically be doing well if you're, the banksters, because people are basically going to sell their stocks and bonds and buy gold. And when they buy gold, it's usually for a long term. It's not a trade. It's like, okay, most of these people that go into gold don't own gold. So they're like, okay, put 5% of my portfolio in gold, put 10% of my money in gold. When they do that, that's not a trade. It's basically, it's going to stay there, right? They don't like it. They don't like gold and silver. It's their enemy in many respects. This is the reason why we've seen a lot of these, lawsuits against gold and silver spoofing. And we had one last year, kind of a big one. And these are like the big banks on Wall Street, the Wall Street banks that get fined for basically spoofing these stuff. And it happens over and over again, right? So we have that. Then it takes a lot of money to push it up over to 26. And so when it went up, that candle went up over 26, it nearly immediately crashed all the way back down, almost the same amount. over a couple of hours, but it took a lot of money to push it down. It's like, why there's nobody that basically was taking profits, because nobody owned silver at 26 because it hasn't been at 26. Now, it's one thing if you have a bunch of people at 26, let's say it goes to 28 and you have a bunch of people at 26 and it goes to 26. Usually when you see these kind of downward candles, it's after the upward movement, and then you have a correction and the Momo crowd comes in. The Momo crowd wants to take profits. That's a chart that makes sense because people, they own silver at 26 and they want to take profits. But there's nobody that owns it at 26 because it hasn't been there. It hasn't been at 26 in a long time. Now you can make the argument, and this is total baloney. You can make the argument that there's people at 26 that bought back in the summer of 2020, and they're still holding it. They're still holding it from way back in the summer of 2020, and they're waiting for it to get back to 26 to take profits. Well, that's total baloney, right? But what happened here is that 27 silver, if you look at the technicals, and trust me, Wall Street looks at technicals. If you look at technicals, once silver gets above 30, there's really nothing that is going to stop it from going to 50. It's like a magnet to 35. And then once it gets to 35, if 35 holds, and it probably will, and then it's a magnet to 50. Mm-hmm. And so they don't want it to get above 30. It's a very dangerous area. And the reason why is because silver has never traded above 30 very much. It went above 30 in 1980, and then it went above 30 in 2011. That's pretty much it, those two periods. And when it went above 30, it was a very short-lived time. So there's no resistance above that. And so 27, now if you look at the chart, so we know 30 is a very, very important level, right? So if it's a very important level, then you get a magnet. I call it a magnet. So the magnets are going to attract it. So the investors are attracted to those levels. So once you get above 27, it becomes a magnet. It's going to be really hard to stop. So 26 to 27 suddenly is a very important area, right? So the minute it gets above 26, somebody comes in with a bunch of money and basically says, I don't want to own silver. If you use Occam's razors, there's just no way that wasn't manipulation. That's where I'm coming from.
Mm-hmm. Yeah, it seems like once we get to that $26, $27 level, it almost seems, to use one of your phrases from earlier, like a perfect storm, because you have investors that really want to see silver succeed. Then you have some momentum chasers that are maybe agnostic towards silver itself that want to chase the momentum of that. And, you have all these factors come together that, as you say, make that $35, $50 level seem like a magnet.
Yeah, I don't think that, especially Wall Street, realizes the opportunity that's kind of manifesting before our eyes here, especially in silver, which has a GSR of 80. And in 1980, the GSR went all the way down to 17. In 2011, it went down to 39, but it was a very short rally from 30 to 50. Mm-hmm. If it would have stayed at 50 for 3 months, I really believe the GSR would have went sub 30. And I think it's going to go sub 30 again this time. Now, why does that happen? Why does silver basically have this big contraction from, 80 to 30, 80 to 20? The reason why it has this massive contraction is because normally silver is valued as a commodity. It's not valued as money. It's not valued as a hedge. It's not valued as a safe haven. So the amount of silver that gets mined out of the ground is about 10 to 1. Some say as much as 8 to 1 on a valuation basis. So the amount of silver, the amount of gold that's mined, valuation basis, is only about 8x silver. They're very tight. It's very close. Mm-hmm. So once silver is valued as money, as a hedge, as a safe haven, that's why the GSR shrinks. It becomes valued not as a commodity, but as money. It's like gold. Gold isn't valued as a commodity. 80% of gold is, well, you could say that it's used in jewelry and jewelry is a commodity, but I don't look at it that way. I look at jewelry more of a, kind of an asset thing. So that's the reason why. And so if you got the GSR getting ready to shrink, And I think it could shrink twice, right? So if it goes from 80 to 40, that's 2x on your money. You got 2x over gold. Mm-hmm. If it shrinks from 40 to 20, you got another 2x. And people aren't looking at it from that angle. If the GSR goes down to sub 30, you're like 2.5, 3 times your money versus, like that's why I say you want to own a lot of gold, silver stocks, although Mexico is kind of messing that up for us. But you want to own a lot of silver stocks because you have all this leverage. And it's just also once silver, there's not a lot of silver inventory out there. You can do your research on this. There's this one guy that has his own little small refinery, and he buys 1,000-ounce bars and he converts them into 10-ounce bars. And he posted on Twitter a bar. This was in March. The bar was made in 2023. The bar was less than 3 months old. And last year, he said the bars he was getting were 2022. So basically, the wholesale market out there is very, very, it's possible, it's first in, first out kind of thing. But this is just one example. I've heard other people say this, that basically the 1,000-ounce bar inventory is not extensive. So once you get to, I think, $35 silver, you're going to get this big move from the retail crowd. A lot of the retail crowd, they can't afford to buy 1-ounce gold coins. They don't have $2,000, but they do have $500 a month of free cash flow from their job. A lot of these people have that, $250, $500, $1,000 a month from their paycheck that they can invest on a monthly basis. Those are the people that are buying silver. Some are buying gold, but a lot of them, it's more kind of the more bang for your buck thing for silver because you don't really want to buy, some people buy small bars, 10-gram bars, 15-gram bars. But, most people, they prefer to stack silver in the kind of the retail crowd. Mm-hmm. So the retail crowd is going to come out of the woodwork once silver gets to about 35. And the reason why they're going to come out of the woodwork is because that's when the mainstream media is going to tell everybody that silver's trending. People love to chase the Momo. So once silver gets to 35 and it's trending, everybody's going to go, I want some of that. That's just human nature. And I think there's going to be a shortage of these 1,000-ounce bars somewhere between $35 and $50 silver. We get to $50 silver and there's no shortages, I'll be really surprised.
Yeah, no doubt. You mentioned, I think you said there that Mexico is kind of screwing that up for us. And, yeah. they're the largest silver producing nation in the world, and they've recently changed their laws around mining. So what are the highlights of that bill? And does it make it a lot more prohibitive for companies to operate in that jurisdiction?
No, I give you the kind of the details. It's not a game changer per se, mm-hmm. But it basically shows you kind of what's coming. Mm-hmm. So I mean, the silver miners are not making any money right now, and they're raising their taxes 5%. Part of this bill is 5% of the profits go to the local community. So they're raising taxes 5% when the silver miners are struggling. The average silver miner right now has very little free cash flow. And the reason why is because inflation has really raised their cost up. I think the average break even is about $22. And a lot of these companies are higher than that. So we really need to get to $30 silver before the silver industry is healthy. So they're raising taxes when the industry is not healthy. So what are they going to do when the industry is healthy? Well, they're going to raise them higher. And so it's what's coming next. We can handle the 5% community tax. That's not a problem. It's the next tax that's really going to bite us, and it's coming. It's inevitable. Like I said, they're raising when the industry is sick. What are they going to do when the industry is healthy? Well,
I think the other side of that, Don, sorry to interrupt, is, when the industry is healthy, and once the industry becomes healthy, conversely, the government is probably going to be a lot sicker and facing a lot more problems at that time.
Exactly. Good point. And so the other one was they want to not give the miners easy access to water. They basically said that they're going to use strong regulations for permitting for water access. That's kind of scary because a lot of times the water where they need the water is available, but there's other communities that could need the water in 5, 10, 20 years. But now what's going to happen is they're going to go to, try to get a permit on water because a lot of times they got to go, a few kilometers away. It's outside of their lease. And now you're going to have people go, oh yeah, but if you give it to them, then this community over here is not going to have that water. That's dangerous. That's that type of because what that's going to do is it's going to make it much harder. Companies are not going to invest in exploration if they don't have confidence in getting their water, because most you have a lot of these open pit mines that need a lot of water. So that's an issue. The other one is permitting is now going to get a little bit more. You got the water, but just permitting per se, it's not going to be as easy as it was in the past. So if you're not building a mine or exploring in a district, if you're in a district, then you're probably going to be more comfortable with getting a permit. But if you're outside of a district, it's going to be harder to raise money. It's going to be harder, if you're a developer, you can't get a permit until you're advanced. You got to wait until a project is well advanced before you even submit these permits. And it takes a long time and a lot of money just to get to that point. So permitting and water and taxes. So it's basically mining unfriendly. And the other one is they're going to reduce the leases from 30 years to 15. So all the new leases, I don't think they're going to do retroactive, but any new leases are only going to be 15. Well, that's not good because if you get a 15-year lease, it takes at least 5 years to drill and build a mine, at least. So in most of your mines, big mines are 20 years long. So if you only have a 15-year lease, 5 years to build it, 10 years, what are they going to do? They're going to give these, once the lease is up, what's going to happen? We don't know. So that creates unknown. So that's scary. Mm-hmm. It's like, we don't, because of the unknown. So basically mining, Mexico's starting to become mining unfriendly.
So Don, do you think that that's, a bigger theme that is going to be playing out here, not just in Mexico, but around the world? And what do you think the risk of nationalizations becomes as those chips start to fall?
Yeah, I've worried about this for years, and now it's starting to come to fruition. So, Mexico was always a mining-friendly jurisdiction, and now it's turning. Chile recently semi-nationalized their lithium mines. And I say semi because what they're going to do is they're just going to the title of the article, everybody said Chile nationalizing mines wasn't correct. All they're going to do is require ownership by the government in these mines. There's a lot of countries that already do this, especially in West Africa, and not West Africa, but all of Africa. There's a lot of these African nations will require some government ownership. And so, and a lot of time it's free carry, sometimes it isn't. And so they're probably going to do free carry since they're calling it nationalizing. So when it's free carry, basically that's going to reduce the value of these mines. But that's just in lithium. But it sets the precedent where, and I think it's coming, where the government demands ownership in their copper and silver mines in Chile just as well. They usually start small. We'll go 5% to start. Then so once silver's at $50, then they're probably going to say, look, you guys are going to have to give us 5 or 10% of these mines. So that's coming, I think. So it's not nationalization across the board 100%. It's nationalization meaning that partial ownership of these mines is going to be by the government. I think that's inevitable. That's the reason why. And here's another one. I see this coming. why aren't people buying up mines in Australia and in Canada? Because these are countries that are not going to do that. They're not going to do this nationalization, because mining in those countries is like farming in the US. They protect these industries, I think. Maybe, Canada and Australia are starting to become very blue, so maybe they'll start to change their tune on mining. But so far they haven't. So far it's and it also can be province only. That's one of the things we're seeing. So the provinces can have higher taxes. It won't be a national higher tax. You could see, Quebec could have a higher tax than Ontario, for instance. Mm-hmm. Western Australia could have a higher tax than Victoria. Stuff like that could happen. But one final point on the risk of this nationalization. I've always said that I will sell my silver miners first because the risk is higher. You have the risk of, silver basically flying higher because of retail, because of shortages, because of safe havens. You got three reasons for silver to fly. And if silver's flying, it's kind of, it's kind of in the, the headlights where, kind of people can go after it. And so there's all these reasons why silver could get attacked. One reason that I haven't mentioned is that I think that the ETFs will become illegal because of a shortage. So if we get shortages of silver, for instance, if Apple has to shut down one of their factories, you don't think that they're going to start screaming at the U.S. government, "Hey, we need silver or we can't make phones," and the stocks are going down. And who owns Apple stock? All of the big, everybody, the big funds all own it. Huge. Apple has huge influence. Huge. They shut down one of their factories because they can't find any silver. Now, it won't be Apple that can't get the silver. It'll be one of their suppliers. One of their suppliers that makes a chip that needs silver can't find it. And so the supplier can't make the stuff, and that's shut. If you don't have a part, you can't make the phone. So I think, so you get your shortages, and the ETFs, I think, are going to get made illegal for silver. Silver will be called, this is supposition. I could be completely wrong. It's not going to happen anytime soon, but I think it will happen. It could happen next year, the year after. Mm-hmm. So once a shortage occurs, once it appears, it's not going to take long for a lot of eyeballs to realize that there's 1 billion ounces in these warehouses of investors. Right. Oh, that's what I was going to say. Silver is going to be designated a strategic metal. It won't take long. Congress will basically say it's a strategic metal. You can't basically have ETFs. No more. They're illegal. Boom. Silver will drop $25 the next day. So I will sell my silver miners before my gold miners, and I'll probably be out 80% of my silver miners by the time silver's at 100. I'll be getting out early because I think silver's going to go to 150, 200, but I'm only going to keep about 20% of them at 100. I'm just hoping that all hell doesn't break loose for silver between 50 and 100. We can get to 100, but I'll be selling in increments, 50, 60, 70, 80. So if we get to 70, 80 before we start having these high taxes or this nationalization talk or illegal ETFs, I'll be fine. I'll be happy with that. So I'm just hoping we get to 70 to 80 before all this stuff all these high risk factors don't kind of hit the fan.
Mm-hmm. Just a quick note there, Don, on the Mexican claims length. The article I was reading said 50 down to 30 years, not 30 to 15. I don't know. We'll have to double check that. But
no, you're okay. Yeah. You're right. I was using my memory. My memory was wrong. I'm glad you fit you. I hope people are still around. Sometimes when you're wrong, people immediately turn it, shut it down. This guy doesn't know what he's talking about. Hit the off button, right? Yeah. There's probably a few people that when I said that 15 years, he doesn't know what he's talking about. Yeah, 30 years is much more doable. So 5. That's probably why they did 30. So most of these mines, by 30 years they're done. If 5-7 years to build it and another 20 years. So yeah, okay.
As long as they're not expanding their resource dramatically.
Yeah, most of the mines, 30 years is going to work. The key here is going to be retroactive. They basically do retroactive. Then because there's a lot of these mines that they've owned for a long time and they're still going. I mean, so yeah, that's something I need to do some research on that if it's retroactive or not. And also, I'm not even sure if it's passed yet. They said it went through the Senate. So I'm not even positive that it passed. Passed the Senate, but do they have, what else do they need? I don't know the Mexican government. Do they need something else to pass as well before he signs the bill?
Right. Don, to your other point about, silver being a strategic metal, considering that the Bank of Canada owns zero gold anymore, do you not think that in some ways could end up becoming a strategic metal within the country of Canada as well because of that fact? Or is it that they'll just require, X amount of every miner or every ounce coming out of the ground goes to the Central Bank of Canada at some point at some predetermined price level?
I've never really thought of it that way. That countries, since it's a strategic metal, that they start requiring these miners to sell directly to them. But it's not that could happen. That wouldn't be shocker, right? If governments decide that they need to create an inventory, the one country that it seems would make sense would be China, because China does produce silver. So, if the Chinese government starts creating their own inventory, I would think China today does have a big inventory currently because they're a big manufacturing country. Japan might have a big inventory too, but the research I've done is not a lot.
Excellent, Don. Well, I think that's a pretty good place to kind of wrap up for today. Is there anything else that you want to touch on maybe before we do?
I wanted to tell people if they want a free trial, they can go to my website, thegoldstockdata.com, and just put /free trial. It's that easy. /free trial, and then enter your email and you'll get a free trial. So it's a really straightforward thing. So, but yeah, thanks for letting me mention that. So,
no problem.
So let's do this again, say the end of August, something like that.
Sounds
September.
Good, Don. And of course, on Twitter at Don Durrett, 2 R's, 2 T's, and your Substack as well, dondurrett.substack.com.
Right,
Don, thanks so much for your time today. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.